Why don't we get started? If that's
yes,
okay.
Okay.
People? Or Volker, can you hear me? Okay.
I can hear you very well. Yes.
Okay. Well, welcome to wherever you are. It's
back
a
home.
pleasure.
Back home.
Okay. It's a pleasure to have you here. PhD, Stanford. I wrote down 1995. Fed, Goethe University. Managing Director and Endowed Chair, Monetary Economics at Goethe, and Council of Economic Experts, ECB as watchers. What more do you want? We're very pleased to have you give a paper today. We're all pleased. And it's with your co-author, Balint Tatar. I don't know if I said that exactly right. I think so. And the title is Taylor Rules and the Inflation Surge, the case of the Fed. So take it away. You have people online and they can raise their hands whenever they want to. I see a few of them, but we're all here anxious to hear what you say. So welcome, Volker.
Well, John, thank you very much for the invitation. Thank you for the opportunity to present the paper. It's a simple paper. I'll bring up the slides in a moment. I'm happy to take questions in between or after, whatever you prefer. So let me bring this up. Basically 5 points. The Taylor rules and the inflation surge. I'm going to focus on the rules in the Fed's report, also their version of Taylor rules. We had a paper a few years ago in the Hoover Monetary Policy Conference with John Cochrane and Sean Taylor, where we also looked at these rules in the Fed's report. And so here, this is a more current version, and I also want to point out some problems or some potential for adjustments or further improvement of those rules. So first, I'll say a few words about the policy challenge, then about the rules as they are in the Fed's report, then about interpreting the Fed's rules in the coronavirus recession. I think that's where they need some adjustment, or some adjustment would be useful. And then about the current situation, the inflation surge, the Taylor principle, first the Fed behind the curve. So I think it was useful, these rules which the Fed interpreted and used itself actually recommended a much earlier tightening. And then going forward, given that they, I think at least ex post, were right to propose or to recommend an earlier tightening. I think now the question is, when should they ease? And so these rules could be helpful in trying to get a handle on that. We see the Fed is a bit struggling with that at the moment. So one can project these rules and one can look at certain key elements of it that has an influence there. And so anyway, I'm happy I can do this online, but I'm also very happy that I'll be coming in for the Monetary Policy Conference in 2 weeks. So I was able to change that and can come. And so I'm looking forward to all the presentations there. And if you have questions about this paper, I can also respond online and in person in 2 weeks. So in terms of the policy challenge, first, just looking at the inflation surge here for the US data, and I just show different measures for inflation, which already creates a bit of a spread. And of course, it matters what inflation rate you pick. The Fed is actually using the core PCE in those rules. So do you see the arrow from my mouse also?
Yes.
So you see the dotted line, blue dotted, that's the core PCE. So that rose, all of those measures basically rose straight after Corona. Also, what I want to point out is interesting, during the Corona recession in 2020, there wasn't much of a decline in inflation. If you remember, it was a very deep recession, but it didn't have a disinflationary impact. But then inflation rose pretty quickly in 2021. The CPI shows the largest increase. In Europe, it was only double digits, by the way. The core, so part of this was energy. And the GDP deflator is basically the broadest measure, but it moves pretty much in parallel. That's That's basically interesting. If you were to look at that for Europe, the GDP deflator is still pretty high in Europe, but in the US, the US is a big producer of energy prices. And so basically CPI and PCE and GDP deflator, to the extent they're driven by energy prices in 2022, moved in the same way, right? There's a little bit, if you look at the CPI, it doesn't seem to be declining more. Maybe one of the reasons why the Fed is a bit challenged. Here you see the policy tightening, right? That happened much later. Basically, interest rates being raised starting in March 2022. The ECB even started later in July. And now we've been at this fairly high level, 5.25, and the funds rate, markets expect that interest rates will come down pretty quickly, but they've kind of been surprised by the Fed keeping it longer, and most recently that also changed, right? More and more of the commentary is that interest rates will stay high longer. The challenge is really the following. I think I like to compare this to the 70s. And here you can see the CPI inflation in red. That's the experience right now. In the 70s, also we had this inflation surge, the blue line, and I've kind of overlaid them. So basically the peak is roughly at the same time. The solid lines give you the timing of the Russian attack on Ukraine here in February 2022. And the timing, back in the 70s, there was also a war, surprise attack on Israel, and an oil embargo. So a lot of similarities. But what's interesting, if you look at this inflation, other than a level difference, because we started out at a lower level, the increase, the speed of the increase and the speed of the decline is very similar to the 70s. So in that sense, it's not unusually fast for an energy price or for that kind of inflation surge. Also, the decline is roughly the same speed, just the level, it's kind of shifted by 2 percentage points. And then, of course, what we expect now, this is from the Survey of Professional Forecasters, is that inflation slowly converges back to target, the dotted line here. In the 70s, it came down, but then didn't quite go back down further and then rose again. And so maybe one of the reasons why policymakers now keep saying, look, maybe we need to wait a little bit longer is because they want to guard against that kind of situation, that inflation picks up again, that somehow they don't win this fight against inflation in a sustained manner. But on the other side, you also want to make sure that you don't cause a recession or something by keeping interest rates for too high for too long, right? So they want to guard against this risk of inflation not settling down in a sustained manner. But on the other side, they also don't want to really keep it too high for too long. You can actually generate the same chart for the euro area. It's similar, it's a little bit, I have to take some average of the large countries here, but it was also a pretty similar speed in the rise and decline of inflation, but a level difference. And also in Europe, we had this second increase in some of the countries.
Vector graph, I don't know why we're making such a big deal about the oil shocks, which happened in both cases well after the inflation was already going. It's very hard to say those oil shocks caused the inflation.
Yes, so thank you. That's what I was trying to point out here at the same chart, that even before, at the first chart, even before the oil shocks, right, this was rising.
Exactly.
Yeah, and so we can come back to that when we talk about, okay, how to interpret these rules. And obviously the exit from Corona had something to do with it, and maybe the policies deployed during the coronavirus recession.
Yeah, just maybe.
Yeah, so exactly. So thanks for making that point. In terms of the rules in the Fed's room, but so far that's just motivation, right? And I think the interesting comparison to the 70s is that the speed of decline and the speed of increase is similar. So it's not unusual. Now, in terms of the rules in the Fed's report, first of all, I thought it was great that the Fed did this. They published a menu of rules. Here is a chart, type of chart they used to show up to February 2020. And then I think it's a great way of being able to discuss policy and also, maybe look at where are some differences. And interestingly, I mean, we talked about that before in this paper with John Taylor and Judd Cochrane, and you can see these rules. This is, for example, the episode before the financial crisis. And so, of course, then the Fed didn't publish those rules. They published them later and then back drafted them to in history. But if they had used them before the financial crisis, during the subprime boom, these rules would have prescribed higher rates. During Corona, I mean, before, with the financial crisis, they prescribed a lowering, just like the Fed did. They lowered their policy rate. They would have gone even negative, and then they prescribed a lift off, which was a bit earlier than what happened in 2000. At least two of these or three of these rules, a bit earlier than what happened in 2016. In terms of the rules, which there were 5 rules also before the Corona crisis, which the Fed used: Taylor rule, balanced approach, adjusted Taylor, price level, first difference. Let me come back to that later. Let's just look at the Taylor rule for a moment, which the Fed uses. And the Fed used a version, their own interpretation. You see there is basically, they use here the unemployment gap. I mean, here's the Fed funds rate. There's some concept of a longer run real interest rate plus inflation, plus these two gaps. The first gap, some deviation from long run inflation. And the second gap, some deviation from some long run measure of unemployment. And in the first case, is 0.5 coefficient. So in total, 1.5 for the inflation. And then a coefficient of 1 on the unemployment rate. So that shows you already they have made some changes. It's not the original Taylor rule, but so here are summarized the changes. So they changed the inputs. Using the unemployment gap makes sense given that they are from the perspective of their mandate, which mentions the Federal Reserve Act, which mentions employment rather than in inflation rather than GDP. So maybe that was the motivation. What's interesting, and that will play a role later on, is they double the response coefficient. So why do they do that? They give a reason. They say there's Okund's law, which suggests that a 2% deviations of output from potential coincides with an opposite change in unemployment of 1 percentage point. So the unemployment moves about half the size. So they say we need double the coefficients. And there's some empirical work from 2013 by Larry Ball and co-authors, which actually comes out with empirical estimates. There's a bit of a dynamic, but if you add up 3 legs of the unemployment rate, you get more or less exactly that 0.5 coefficient. So in that sense, that when they set this up at the start, that seemed to make sense. For inflation, as I mentioned, they used the core PCE. Original Taylor rule used the deflator. The long run, they used to use some blue chip forecasts, median for the longer run neutral real interest rate. Most recently, they switched to something from the survey of primary dealers, but that's, it's very similar. For unemployment in the same way, I mean, they could be using their own forecast for unemployment in the long run. This is what we plug in later, but that's not what they use for the charts. So what's interesting, I mean, there are 2 things which I find interesting. One is looking at this in the current situation, but also looking at this during the Corona recession, how the Fed interpreted those rules. So they changed it. They had a strategy review, and then they basically kicked out one rule. They dropped the price level rule. They added something called the shortfalls rule. So, I mean, what are the 5 rules? The first one, there's no change. That's their interpretation of the original Taylor rule. What they call balanced approach just doubles. I think it's something Janet Yellen, when she was chair, thought was of interest, namely to an even stronger coefficient in terms of the reaction to unemployment. So they have a coefficient of 2. If they would do it in the output gap, it would be a coefficient of 1. And the shortfalls rule is they basically just look at shortfalls of employment. When employment goes above what they think is the long run level, they just don't react to that. So that's their new interpretation of their mandate because it says maximum employment. That can introduce a bias, but I don't want to touch on that now. The other two rules, for the purpose of this talk, they're not key. Let me come back to that if there are questions. So they stopped briefly during the strategy review publishing this chart, but then they basically brought it back in February 2021. And when they brought it back, it has this big decline, right? They brought it back in February 2021, and you have this huge spike down, which basically has never been seen before. So interpreted like this, it means that the Taylor rule or the balanced approach rule would have called for lowering the policy rate in the second quarter of 2021 by 20 percentage points. 20 percentage points. Well, that never happened before. I think the largest decline was maybe something in a short period was something like 5. So that's crazy. So it looks a little crazy, especially since in the next quarter, in the third quarter of 2020, most of that easing is taken back. Now, of course, this could not be implemented because this goes into minus, and the Fed wasn't going to lower anyway. But shown like that, it makes the rules look a little bit giving crazy prescriptions, or at least calling for some interpretation. So here is the Fed's in their multi-policy report. They actually have an interpretation. So I'm just citing that interpretation. They say these deeply negative prescribed policy rates show the extent to which policymakers' ability to support the economy through cuts in the policy rate was constrained by the effective lower bound during the pandemic-driven recession, a constraint that helped motivate the FOMC's other policy actions at the time, including forward guidance and asset purchases.
This is just a remarkable quote, because the Fed is saying here that in the middle of a raging pandemic, with half of the economy locked down by government fiat, if they could only have lowered interest rates to minus 18%, GDP wouldn't have gone down at all. Just absolutely crazy. They've never heard of supply.
Well, I think you're exactly helping me move along with my points. Thank you. I mean, first of all, they might not have thought that they could have done much to offset the GDP drop. I mean, not completely, but certainly, it sounds like given that large cut in the funds rate, anything is justified. It sounds like, hey, look, we did a lot of stuff. We bought tons of assets. We probably bought more government debt than the newly issued government debt. And remember, I don't need to remember you, but to remind you, this was the fiscal measures which were taken were essentially financed by asset purchases. There was essentially indirect monetary financing on a huge scale. And so this interpretation could be interpreted, or this state quote could be interpreted as saying, well, even Taylor rules basically said we should do whatever we can, So let's buy up all the government debt newly issued to finance these three huge fiscal programs. All right, so I wanted to take a close look at that. Here is the
Volker,
chart.
can I ask a quick question real quickly on that? It's good to see you. I'm sorry.
I'll come to supply. So, John, I will be talking about supply. That's basically my main point here. Yes?
Okay, Mike Boskin has a question.
Hey, Volker, I know you can see me. I'm the opposite side of the room. Everyone is looking at me as well as you. So you may be looking at the back of my head, depending on the cameras.
We can see you.
Okay, good. The question is, what are the legal what are the legal restrictions, the equivalent of the 13.3 Fed guidelines on what it can buy, what credit it can accept, et cetera? Because at one time there was talk, in our case, the Fed wound up buying a lot of things here, mortgage-backed securities, not just long-term government bonds, but there was some talk at various times of them buying munis, corporate bonds, stuff like that. So what legally can the ECB do, or what legally does, say, the Bundesbank have any sway over?
So you mean looking to Europe, what we can do?
Yeah. Is it legal for them to buy anything they want, or are they legally constrained?
No, they can pretty much buy whatever they want. I mean, maybe not real estate, but certainly mortgage-backed securities or corporate bonds. They didn't buy equity, but presumably they could probably do that too. I think the Swiss National Bank bought equity. But the history was one where, the Bundesbank already was allowed to take lots of different collateral, including it was common to take bank securitized loans, or that was a common thing, short-term debt from real companies. All that was used, available as collateral at the Bundesbank. And so the ECB inherited that broad approach. So in Europe, there's a lot that can be done.
Okay, thank you.
So coming back to the rules. So if you project this a little further, you will see that by June last year, the policy rule chart had moved in the opposite direction. So you have this sharp drop during Corona, and then the Taylor principle kicking in, along with inflation, the policy rose very quickly. So let me take a look at the gaps in a moment. And we already said, look, this was a very extreme drop. This V-shaped movement was basically coming because GDP fell by 10% in the first 2 quarters and then quickly recovered thereafter. And John Cochrane already said this, of course, and people even in real time, everyone looking at that said, well, this is to a significant extent supply moving down and demand moving along with supply. The unemployment rate increased from 3.5% in February to 14.8% in April. So it also increased 10%. And by December 2020, it was almost back to normal, right? 6.7 was still pretty high compared to the 3.5, but more normal range. So if you look at the gaps, here's a picture of the gaps. Here you see the sharp drop because of Corona. And the first thing I want to point out is unemployment moved 1-for-1 with GDP. And remember, the Fed talked about Okun's law. They doubled the coefficient. And certainly when you had these extreme movements, Okun's law didn't work. So in a sense, you would say, well, jumping back to that chart, if you look in real time that unemployment is moving as much as GDP, you should cut the coefficient back down to 0.5. So we would be, the Taylor rule would be going down to -5, not to -10. Or the balanced rule would go to -10, not to -18, right? -9, not to -18. So that's just a simple observation. I mean, I told you I'll keep things very simple. So, I mean, the simple thing says half of what this rules chart shows is just a misinterpretation because unemployment is not moving half, it's not moving half as much as output is moving the same extent, namely 10 percentage points. So, I mean, that's a simple adjustment they could have made right there and then. Right? So Okun's law is not a law, and it certainly didn't apply in the Corona recession. Now, the second point I'm trying to deliver a little bit more I mean, John Cochrane already said this. Don't we need a model of supply here? I mean, basically, the output gap is calculated with respect to the long run potential. So, but we all understood very well that we're not going to the that we're going to have a supply side reaction, and the relevant reference point is not the long run potential. So here I'm trying to basically bring to bear a little bit more analysis. Let me jump forward through my slides. So what was happening? We're going to propose to take into account a model-based concept of the output gap that actually captures the supply side effects of the pandemic. The pandemic had a similar impact on aggregate demand and aggregate supply. Basically, even if for a moment you say, what if there had been no shutdown? So forget the shutdown. Let's just assume for a moment there wasn't even a shutdown. Even then, people would have feared infection. And so they would have reacted and reduced contact-intensive consumption. They would have probably induced work hours. Employers would probably have shut down contact-intensive production. In fact, I mean, I don't know all the details in the US, but certainly in Germany, certain businesses were shut down, not by the government. I mean, car sales were not conducted, even though, they could have been conducted without contact, right? Not everything is like food, like restaurants. So in some places also employers shut down to avoid spreading the virus at the workplace. In the US, they dismissed workers. In Europe, they mostly had workers go on short-time work. And then on top of that, you have a second supply restriction where basically governments say you're not allowed to work to reduce the risk of infection. So more or less demand and supply of contact goods and services moved in lockstep, first sharply down and then back up. So I was a member of our Council of Economic Advisors, and we certainly recommended at the time that the policy is not to stimulate production by lowering interest rates or bringing up government consumption. It was more like give loans or give transfers to help people through this. But certainly the central bank stepped in on a large scale to finance those transfers because they bought up the government debt, which was issued to finance those transfers. And so they put money into the economy. So it was a money-financed fiscal stimulus. But the important point here is that the relevant gap, which indicated disinflationary pressures, was much smaller than the deviation from long-run potential. And we'll basically here consider the class of macro epidemic models, which were, you might remember, John Taylor and I, we organized some online talks in spring 2020, where people were presenting those models as they were being developed. Basically, people were putting epidemic models into the macro model. Eichenbaum, Rebello, Trabant is one I use here. They have a sequence of papers. We actually have a model database where you can look at those. I don't have much time, so maybe I shouldn't try to show you this. Let me show you the simulation on the chart. What happens in these models, this is like a shock. The pandemic there's an initial shock where there are some first infected people in China or Chinese coming to Europe or to the US or either way, right? So in this initial set of infections then spreads, and then you can see my cursor.
Yes.
Yeah, so this is weeks, so people get infected. And then when enough people are infected, this would die out by itself. Of course, we didn't let it necessarily get all the way there. But this is basically the path of such an epidemic. And what the model says, the model which basically then explicitly takes into account the fear of households and firms, households and workers, the fear of infection, so they shy away from contact-intensive consumption. So you can see consumption drops, the labor supply drops, and that induces the recession. Now, a big chunk of that is supply. And here I'm using a new Keynesian macro epi model. So that epi can actually distinguish. That model has a stochastic, has staggered prices contracts, and therefore it can distinguish between where output would be with flexible prices. That's a measure of supply, if prices can fully adjust, and where output is because prices are rigid. And you can see that the recession is a bit deeper, the blue line. It's about a percentage point deeper than under flexible prices, or let me say fully flexible prices. But the gap, and here the gray line is the gap. So you can see once one takes into account, I mean, as John Cochrane asked, once you take into account the supply side of the pandemic, the gap is much smaller. And in that model simulation, the inflation rate actually also only declines about 60, 70 basis points, which interestingly matches what happens. So if you look back to the first chart, remember here, how much did inflation decline? Well, in 2020, these measures dropped about a percentage point, depending on what measure you look at. So in that sense, that's a pretty cool, I mean, how often does a model turn out to be pretty much on track for such an extreme prediction, right? I mean, the prediction is that even that in this type, an 8% recession would only push inflation down by less than a percentage point. And therefore, in the model, the Taylor rule is also in the model, and the model calls for about a 1 percentage point in the interest rate. So we conclude that the resource gap used for the rules in the monetary policy report should be adjusted. We propose a simple adjustment. In principle, you see it's about 1/8. The gap is about 1/8 of the long run deviation. So if you use a factor of 1/8, this chart looks like this. Right? You see at the time of Corona, the Taylor rules go negative. So you could interpret that as a call for bringing in some asset purchases, but they don't look crazy. They don't look like, let's throw the kitchen sink. And actually, they are much more aligned with the kind of considerations which were debated at the time. So I think that gives you the right interpretation. So hopefully that's my long answer to John Cochrane's point. Are there any more questions on this? My other point will be on looking at what these rules have to say basically during the inflation surge and looking forward about the timing of policy easing.
I have one, Volker. So Pete Klenow and Mark Bills have pretty much developed convincing information that prices are pretty flexible. Wages may be another story in the short run for various reasons, although the share of workers in the US that are unionized outside the public sector has shrunk to very small. So how flexible are prices and wages in Europe? Are there comparable studies?
Well, I think there are two ways of looking at that. Looking at this in terms of the aggregate data, and then looking at this in terms of the micro data. And so Klenow Bills look at the micro data, and so individual prices are adjusted pretty frequently. But if you take a model which has aggregate staggered contracts, typically now, say these models have both. Some have wage rigidity and price rigidity. And interestingly, when you take the models which are estimated to fit the aggregate data, the inflation and wage inflation data for US and Euro area, they are not that different, surprisingly. So they're not that different. But that's in terms of the macro modeling perspective. In terms of the micro perspective, I mean, certainly union wage coverage is much bigger in Europe. The percentage of wage contracts in Europe covered is much bigger. So it depends country per country. It's different. But if you look at countries such as Germany or France, the large share of wages is covered by union contracts, right? But even so, interestingly, at least from the macro perspective, the models, once you fit them, they have some differences. It's not a huge difference.
Question on Mike Bordo.
Yeah, Volker. You know, they had this measure at the Atlanta Fed of a sort of a pseudo funds rate, right? And that's what they used during the period of the zero lower bound. So what happens if you look at that? Okay, I mean, what do those gaps look like? I mean, I know that that's not going to change the calculations they did, but in a sense, it's going to get more at the question of how serious the gap was.
Yeah, I mean, if one would use those pseudo fund, so I don't know. I'd have to check. But of course, also during the whole zero rate or negative rate period, we had these different measures of pseudo fund rates, which were calculated, basically looking at the yield curve and then projecting, given how much the yield curve was depressed, or flattened, how low would the funds rate go to kind of capture that. What that would do, the green line, right? The green line is the funds rate. It would move it closer to the rules.
Yeah.
But, jumping back to the earlier chart, right? It wouldn't move it to -20, I think. But
right.
We can go and check. I don't know it offhand.
Yeah,
but certainly I think here it's an interesting comparison. I mean, these adjustments have their own problems. These pseudo funds rates have their own problems because normally they should be going to zero as soon as the rate lifts, the short rate lifts, even though the balance sheet is still there. But anyway, so I can't say much. I have to go back.
Mickey Levy has a question.
Volker, I have one comment, and that is, you mentioned Oken's law. So Oken and Boul in his 2013 paper.
Yes.
Oken's law fell apart well before the pandemic. So the interpretation of that shouldn't have been kind of an ex post. They should have anticipated it in their calculations. But then the other thing I would bring out is transitory. So the Fed perceived all of this as transitory. If businesses also perceived it as transitory, their pricing would have been different. And so,
what is transitory?
The perceived negative supply shock. So if businesses actually perceive this to be transitory and they were having supply bottlenecks, then price adjustments. I'm not surprised that prices didn't plummet. And I would just add one other point. When you look at GDP, a sizable portion of it is imputed. So even during that quarter where GDP fell 9%, people still consumed housing and they still ate and everything. And so the decline in, so it's a data issue as much as an economic issue.
I mean, so first, I definitely agree with the transitory. This is concerning the Corona recession, not the inflation surge, but the Corona recession. I was also on this side of the Atlantic, very much involved in preparing, a net policy analysis, and we were basically projecting either a V-shaped recession or maybe something where the recovery would be partial. But basically, it was clear that, with the end of the shutdowns, there should be a pretty quick recovery. So from that perspective, but not everyone was saying, yes, don't worry about this inflation. If you were looking at what the central banks did, they certainly did extreme measures. Just not negative rates of 20%, but they certainly, in Europe, they bought up more assets than the newly issued debt. It's pretty extreme. So in that sense, even though it was supposed to be transitory, and also the asset purchases in Europe, and also the Fed's asset purchases, they lasted much longer than the V-shaped recession. So they didn't, some people were saying it's time to get out of the support, but both monetary and fiscal support were maintained quite a bit longer. So they maybe should have known better. But because it was clear it was transitory, but the policy response was not transitory.
If I could just add to Mickey's comment. So when unemployment was very far down, we've got to move right now because unemployment's so terrible, even though we know it'll go away as soon as the pandemic goes away. Yeah. Inflation goes up, and then they're applying a Taylor rule, but not to actual inflation, but to inflation forecasts. Yeah, well, it's going to go away, so we don't have to respond at all. It's kind of a curious respond by buying $3 trillion of debt immediately versus on the other side, well, it's transitory, it'll go away. We'll target the expectations, not the actual variable.
Yeah.
But they're also thinking of a Phillips curve, and even though, the unemployment rate was coming down, but still above their U star, even though they should have known for a dozen years that Okun's law and the Phillips curve had fallen apart.
Plus, there might be a little bit of shock.
Mickey, Levy, I forgot to respond to that point of Okun's law. So I didn't put much stake into that, but I did go back and look at this paper by Larry Boul. They published this in 2013. And I have the regressions at the end of my slides, but I don't want to jump to that right now. But it's pretty interesting. The coefficient there was coming up to 0.5 over 3/4. And so my co-author and I, we have since then re-estimated that with data up to 2019. And actually, the 0.5 coefficient survives up to 2019. So I would somewhat disagree with your statement that it fell apart. Just extending the regression from Larry Boul, it works pretty well till 2019. But then, of course, once you throw in the 2020 gap, then I showed you the data. Once you throw in this, where the unemployment gap moves parallel to the output gap, then the Okun's law the coefficient moves up to 1. So anyway, on that, but they should have known this because you could observe it in real time during Corona, right? During the first half of 2020. So let me quickly talk about this period here. As you pointed out, John Cochrane, and you others know, of course, there was a lot of conviction suddenly by the Fed that this would be transitory, and any forecast predicting that the inflation quickly fall back, was a good forecast and was fully reliable. The rules the Fed used, which I think is a very good thing, all the rules, even the first difference rule, which is normally sticking close to the actual policy. All of them basically said, look, you need to tighten policy. In this adjustment, look, the area where we adjusted the output gap, that doesn't play a big role for the inflation surge. Even if you don't adjust it, the rules are in positive territory pretty quickly. But clearly, you see here, so they would have called for tightening during 2021. The Fed eventually tightened. They realized it's not transitory. So we basically are at this point. So now the question, I mean, my simple point would be the initial challenge I motivated. I said, look, they don't want to make the mistake. I mean, they reacted too late, but at least now they want to make doubly sure that inflation goes back to target. But on the other side, it's still reasonable to say, be careful. You also don't want to keep rates too high for too long. So given that the rules gave a good signal when they should have raised policy rates early on, the rules might be something interesting to look at for the period of policy easing, right? The benefit of the rules are they are symmetric. They are not eternal hawks and they are not eternal doves, right? So looking forward, when are they coming down? So
Volker, could I?
projecting the rules forward, you get this chart, and you can see that basically now in the second, so the rules stayed above the actual funds rate. With inflation coming down, the rules have come down. The funds rate has remained at 5.25. And interestingly, now we're in the second quarter, these funds rate prescriptions from the rules are crossing where the Fed stands. So actually now they could give additional food for thought about when is the time for policy easing. You can project. Yes.
There's two sort of tailored approaches. One is they should follow the inflation rate. The other is explaining what they did. So if we put a Taylor rule in, but we use their own forecasts of inflation a year from now, do we get the reason for their slowness? I mean, can we describe what they were doing as following a rule, just using their inflation forecasts? And the problem was that their inflation forecasts were pretty terrible.
Yeah, I mean, that's a neat little check. I mean, everything is very simple here, and that's an additional interesting thing we should do. I mean, absolutely, right? It would be it could be. I'm a little skeptical. I think even the forecasts, depending on what you looked at, were drifting up, right? That we could also look at market forecasts versus in their own forecasts. The market forecasts, depending on what you looked at, moved kind of eventually with the short run forecasts moved with actual inflation. But so I don't have a good answer because I haven't done the calculation, but that's a nice.
It was a suggestion, not a question.
Yeah, exactly. That's a nice suggestion, easy to do, and we'll see if it helps exactly illustrate or. Actually, if I remember, say, if you look at surveys, some of the surveys were moving up. Remember at the Hoover Multi-Policy Conference, we had this paper with Ricardo Reis, which I was discussing. He was showing some evidence at some of the forecasts and also some of the probability distributions moving up in the second half of 2021. So actually, I think the Fed even I suspect the Fed overdid it even from that perspective. But I'll check.
Yeah, I think you're right. I mean, there was a lot of talk about we don't have to move because the expectations are still anchored. It will be fun to check.
Exactly.
Now, we also, I think in the model part, responding to expected inflation tends to throw model dynamics for a complete haywire. It's not a good rule, even though it's what they tend to do. But anyway, back to your talk.
Yeah, I mean, with the models, if you respond to market participants' forecasts, there can be pretty negative outcomes. Bernanke and Woodford had a paper on that many years ago. If you respond to your own forecasts, the central bank forecasts, that can work. But if they are far out, if you respond to a 1 or 2 year ahead forecast, again, you can get multiple equilibria more easily. So forecasts, from the model evaluation perspective, you should only respond to near-term forecasts. And so that's why, that's where I'm coming from maybe the near-term forecasts did move up. I think that was right. And indeed, as you said, there was a lot of reference to the anchoring. And because of the anchoring, see, the long-term forecast being on target, that one could allow a short-term deviation. Right? And there was a lot of discussion that this might be an optimal response to a transitory cost push shock or a transitory oil price shock or energy price shock. Okay, first of all, here we basically do the projection of the rules exactly as they use them, but then plugging in the FOMC's own projection. I mean, a number of people have done that. Again, nothing fancy, but simple. We can see, interestingly, if you do that exercise, you plug the FOMC's own projections in there of core PCE inflation, of unemployment, and importantly, their estimate of our star. You know, they have an estimate of our star, which is basically 0.5 percentage point. Then you see these rules. Then these rules would be even more dovish, or they would be even more anticipating a decline, a return to policy rates, low policy rates, even faster than the futures. Right? We did this chart in early March 7th. So you can see futures in March. No, this is not the futures. This is the funds rate predictions of the FOMC, right? Also from their projections. So if you plug in their predictions for the funds rate and then compare it to the rules predictions for the funds rate based on the FOMC's predictions for unemployment, inflation, and our star, the rules go down much more. So here are the, right? So this is basically, of course, the end point here is important. They could basically go down to 2.5 pretty quickly over the course of this year and early next year.
Question or comment. I have a paper, David Papel and I actually. Hi, David. I think I see him around. So we wrote a paper, policy rules and forward guidance following the COVID-19 recession, and our paper covered the same kind of material, and we also have a Econ browser post that was last week. And so we are looking at Taylor rules and balanced approach rules and analyze version of the rules that were in accord with the revised statement, the 2020, August 2020 revised statement. And we use data from SEP from September 2020 to December 2023 to compare policy rule prescriptions and with actual and FOMC projections of the FFR. So if I'm looking at your numbers, in terms of the non-inertial rules, we get very similar numbers, if we compare with your output gap and adjustments that you're making. And also we are getting a gap about 700, 800 basis points. I'm just looking there. So very similar. The big change is that when we compute inertial rules, and that's where we see the difference. We actually get about between 200 and 300 points, the maximum gap between the FFR and the rules. It's about 250 points in March 2022. And so going forward, 2024, 2026, the non-inertial rule prescriptions are giving us also very similar results with yours. But then again, the change is when we're using inertial rules, the policy rules prescriptions are very similar, are very close to the FOMC projections. So it's more like a comment, or have you looked at inertial rules, or because it seems that based on our paper, they work pretty well in both cases, before and after, projection and before.
Yeah, I mean, first, great comment. And so here we just, I mean, in earlier work, for example, in the paper with John Cochrane and John Taylor, we also talked about what rules should be added, and we considered some of the rules from David Papel, and probably you in an earlier paper. But here, and we put them in models also. Right? You had a rule, or David had a rule. You got probably on that paper. I didn't get your name.
Yeah. Mm-hmm. Yeah.
And we had an NPP rule where the coefficient on inflation was raised, right? So so we've looked at your rule, and we've looked at you. I'm just trying to say, in our past work, we looked at your work and took it very seriously, even also suggesting, for example, this more inflation fighting rule. So here in this paper, I just wanted to look at the Fed's own rules. And I just wanted to look at the Fed's own rules on their turf with their data inputs. And so that's why, for example, here, I have not included an inertial rule, which would be something putting a coefficient, I don't know, of 50 or 80%, 0.5 or 0.8 on the lagged funds rate. And then you would be somewhere, whatever coefficient you put, you're somewhere in between this range. Right? That's what you would be driving towards.
Ruxandra's point is excellent. It is interesting that the Fed's own rules don't include the one that it said in its own strategy review. Here's what we're going to be doing.
Yes, yeah.
So
Just a little comment. We're not in this paper. We haven't used the rule with the coefficient on inflation gap. So we're not using that. We just use what I mean, not all of the rules, but the rules in the monetary policy report. We're not using our own rule. At some point in one of the papers we use that. But yeah. But it seems to me that, I mean, it seems to us that when increasing interest rates, they say, and it seems that they're smoothing the interest rate. That seems to be a pretty good, yeah.
Yeah, but interestingly, so let me maybe respond to that second point, to the row I call it partial adjustment. The Fed, interestingly, in its report did not include such a partial adjustment or smoothing rule, right? It's not among the 5 rules. What's interesting is they do have a first difference rule. The first difference rule, if you look at the coefficients, the first difference rule is down here. It has a coefficient of 1 on the lagged interest rate. So that's in there. So basically, the Fed themselves did not use a partial adjustment rule or a smoothing rule. So, they might still smooth, but the idea, I guess, was that it's useful to look at the point where you want to go. That's basically the 4 level rules. They give you a level for the interest rate to which you want to move. And then the first difference rule gives you something where you have a big weight on the lagged funds rate. And now what's interesting in terms of the chart, even the first difference rule was giving you 300 basis points here difference in March 2022. So that's a pretty big deviation. That's not what you would expect, given that it usually sticks close or fairly close to the actual setting. So
okay, lots of people have questions, so maybe we should proceed. So Alvin, do you have a question?
I have 2 comments. The first comment is that in 2022, almost everybody was grossly wrong on the inflation forecast. And I mean grossly wrong, with top end ranges no higher than 5%, medium ranges lower. The actual rate was 6.5 on the CPI. They did a little better on 2023, but once again, they're grossly wrong in the first 4 months of 2024. Now, that should tell you something about this whole business of trying to forecast inflation, whatever rules you're using and however you're using them. And now I want to get to my comment on your paper. The last 3 sentences of your paper struck me as a contradiction to your whole paper. Now, that's harsh, but I want to make the point. You say, interestingly, 4 of the 5 rules already indicate a federal fund setting below the current target range in the first quarter. That's wrong, obviously, but you qualify it by saying a note of caution. You say, given the calculation is based on a perceived long-run real interest rate equilibrium of 0.5%, it could be higher, so maybe by summer. Well, Powell told you yesterday that's wrong. Okay, so you're wrong before on the first, you're wrong in the future, and all I'm just saying is when you play with these rules, if instead of having 0.5, why not 0.6, 0.7, 0.8, 0.9, 1.2? Somewhere along the line, if you keep doing it, you'll look back and say, wow, I got it. But this is wrong in almost every respect. So I think part of the problem is that when you think about looking at inflation ahead, Larry Summers said, good God, we may have to raise rates before this year is over because labor demand is so strong. And this guy over here, John Cochrane, says, oh my God, the deficit, they got to stop this deficit or we're going to keep having a problem. And well, there's a bunch of other people have criticism. So I think there's a very risky business here in playing with rules where you can't get the basic fundamental number right, no matter how you try to do it. And I think there's a reason for that, which I won't get into now. And I should just say, I got the forecast right for 2022 at 6.5. That's another story, and I will tell you off the record sometime how I did that.
Thank you. So there's other people with questions, so should we continue? What do you think?
Questions?
Questions?
Well,
So
this was maybe, John, given that everything is wrong, I have a chance to respond. I mean, because otherwise, we forget. And
okay.
We wouldn't want to forget if everything is wrong. Can I quickly say something?
Yes.
Okay, so first, thank you. But I mean, so this is not a paper about who has the right forecast, right? If anything, what those rules say is that you shouldn't respond to forecast, but you should respond to outcomes, to actually inflation.
You don't know that till after the fact.
Yeah, well, no, it's not after the fact. Now, let me just, it's during, so what these rules clearly delivered, as inflation was rising, all these rules were saying you need to tighten. And at least now, I think there's nobody who would say that would be a mistake to have tightened earlier. I think it's pretty clear that they would have been better off to tighten earlier. This is what the rules recommended. And you have to look at the rules from a normative perspective. The idea was these are rules which more or less perform well or reasonably well in macro models, maybe also in certain empirical episodes, historical episodes when they were close to what was actually done. So it's not predicting interest rates. It's about what would be, from a normative perspective, maybe a good policy. And I would put to the table that the proposition that it would have been a good idea to respond earlier to this picture of the rules which the Fed itself was showing. And then the only question going forward is, when are they coming down? And I agree with you that this over here may not be a good forecast. Absolutely. But I'm not saying you should take that as a reason for action. I'm saying once you have the outcomes, and we're basically here, that you can take. And if you look at this table, so here is the table for the different rules. And this is the statement you refer to. And it's actually true that these rules are below, 4 of them are below the current funds rate setting, even in the first quarter, and definitely in the second quarter. And then the only point I make is an important ingredient is something, it's this long run rate, right, of 0.5, which is coming from the Fed. And there you might say that's an unobservable. So what if the what if the long run rate is, say, closer to a potential growth rate? The current CBO potential growth rate is 1.8. And so once you use that as an alternative, so I'm putting that forward as a potential alternative. It's also closer to the original Taylor rule if you want. But even if we use that, you see that in the current quarter, basically all the rules are right at where the Fed is. So going forward, so at least it's a good time to think about, is it the time to change or is it soon thereafter? So that's just looking at using the rules in response to the current data.
So Volker, there's several people have questions. Let's check with Jeff Lacker. He was there. Jeff.
Yeah. Thanks, Volker, for this paper. It's incredibly useful to focus on refining the sort of the supply side of that setup, and to try and push the Fed and the world, or the related world, off of this notion of the non-inflation, accelerating inflation rate of unemployment that's really smooth. When theory tells us that, you start respond to just about every shock. And I noticed that this parallels sort of the work Hall and Kubiak are doing on this. And a point, I think I made this point in the paper with Charlie Plosser on Taylor rules at the conference last year. I would just point out that final comment that the Fed publishes this set of rules that you showed that they publish, but the prose material surrounding that thoroughly trashes the notion that they have any use in making policy. So the campaign to refine these rules and make them more consistent with economics, take the economics of the rules seriously, is useful, but I think it needs to be complemented with a campaign to get the Fed to take the rules seriously. You look in the transcript, there's virtually no reference to it. While I was there were like 2 or 3 people that mentioned them from time to time, but it was clear that the kind of central leadership did not take them seriously at all and didn't want to hear about them.
So there's a quick response.
Right. So Jeff, like I have this project that I haven't shown anybody yet that develops a dictionary on rules versus discretion at the FOMC, going all the way back to Volker. Okay, and so when you did this, you see that they use the language a lot more over time. Okay, but when you look at the outcomes, it doesn't change things much. So it says it's backing up what you're saying. So they're using the rules and they're covering themselves, and they say, yes, we do this, but it doesn't really affect what they actually do.
Okay.
And thinking about why the Fed failed to tighten for so long, it's important to remember that back in September of 2020, the FOMC made a commitment that it was not going to raise rates until not only inflation was above 2%, but the unemployment rate had dropped, I believe it was 4%, or we had reached an approximation to full employment. And that the FOMC interpreted as a binding commitment, and they weren't willing to destroy their credibility by abandoning that. Now, you can argue that that commitment was a mistake. And in fact, Rob Kaplan, the president of the Dallas Fed, dissented against that FOMC decision. But that's a different question. Given that they had made that commitment, they felt obligated to live up to it.
So David Pepel, you're next in line.
Okay, I'm going to be a little less polite than Ruxandra. You've basically presented our paper as original work. And if you look at everything that goes up until now, then what you have is you've made changes. What we basically do, to make it quick, we just basically take everything from the SEP. We don't try to improve on the Fed. Right? You make these changes. Okay, let's stipulate that you're right. And these things, this is how it should all be done with the Okun's law, the adjustment, and all that. Let's take March of 2022, which is the peak gap between policy prescriptions and the federal funds rate. It's 8% in our paper, 7% in your paper. Then looking forward, you're doing the stuff with the forward things with the SEP, which is identical to what we have in the paper. And I will just point out, I've presented this paper twice at this seminar. Rich Clarida talked about it twice in the Hoover Monetary Policy Conference. It's you've been on the mailing list for it. Okay, I'll stop with my rant.
Okay.
But on the inertial versus non-inertial, the one policy rule that has really come out from the Fed since the COVID-19 is Rich Clarida, who in a series, almost the same paper that he gave in November 2020 at Brookings in January 2021 here, had an inertial rule as the rule that how he would analyze policy going forward. And lastly, I totally agree with what Evans said, and that's also in our paper.
Volker, you want to respond to some of these comments?
Yeah, absolutely. I mean, David, don't worry, don't get worked up. I have no. I mean, basically, I see your contribution. I mean, first of all, doing the SEP rules from the Fed. I'm not claiming that I'm doing anything novel. These are obviously the rules of the Fed. I'm not. I'm saying these are the rules in the Fed. They were in the Fed report before you wrote your paper, and before I wrote my paper, right? And before we wrote the last paper on this. So I'm not trying to say that I invented the rules of the Fed, or I basically I'm the first one to plug in the SEP forecasts. I wouldn't say that, because we've been doing, as you correctly say, I mean, also Jim Bowler did it last time. I mean, if it makes you happy, I'll make sure that I cite everyone who at all times used it's after all the Fed's rule in their report. They the originator, neither you nor me. I see your contribution in two ways. At some point, you advocated that they should add an inflation fighting rule. And more recently, you've been advocating that they should be using inertial rule. And I'm not saying, neither of those 2 points are in here. So I'm not taking your original points. So let's be clear. I think these are good original points. If it makes you happy, I like you to be happy. I'll put in the next version, I put in the next version a reference that one could also look at inertial rules, in that you have been pushing for that very strongly and have done it like that, but we're not doing it here. But I'm certainly not trying to say that I'm the inventor of the rules the Fed has set up in its report. I'm just using it, and plugging in the SEP is nothing special. I think the unique contribution here, we could probably also agree on, is to use a supply side approach. I mean, to point out that Okun's law failed. If you pointed out that Okun's law failed, I'm also happy to reference that, because I didn't remember that. I don't think you did, but maybe you did. Then I'm happy to reference that.
Okay.
But my point is, look, we have put together, we think of, and this relates to, I think, the very nice comment also by Jeff Lacker. Jeff, you pointed out the pros of the Fed has been dismissing these rules. Now, if you basically take the quote I quoted, interestingly, at the one point where the rules gave the most extreme recommendation in the Corona crisis, suddenly the Fed puts more than negative pros. It puts a comment, which I quoted, which says, look, these rules actually serve to justify the extreme measures we have taken. So if you want to find, I mean, my impression, at least, I've been trying to make this point also a year ago in the conference, but I think it was kind of missed. But I think one needs to adjust these output gaps. And we've put together a database of macro epidemic models, which provide you the quantitative tools to make that adjustment. And it turns out it's a simple adjustment, and it applies to the one point in time, so referencing Jeff, when the Fed actually made a very positive comment and was trying to use the rules to justify what they did. And I think they do it right at the wrong point. And if anything, I hope that you say, Volker, maybe that's at least putting that point forcefully is worth it. And then that's why I think it's worth doing this paper.
So Athanasios has a question,
so
and Mickey.
Let me respond to Evan's point, and that will bring me to Athanasius. I mean, Evan, you said they made this commitment. I think that commitment was wrong. The ECB and the rules showed that the commitment is wrong. And Athanasius actually has a very nice paper, which I'm not citing here, but if you want me to put something into with regard to commitment, Athanasius has a very nice paper he called The Forward Guidance Trap. He applied it to the ECB, where he showed, the ECB was really pulled into a trap by the commitment they made.
Okay, Mickey.
Look, I think one of the great things your paper brings out is that by summer of 2022, the Fed was violating every one of these rules. I do have a concern with using the SEPs for forward estimates of the funds rate, because if you think about the SEPs, they're conditional, and the federal funds, the FOMC members' federal funds rates are supposed to be their estimates of the appropriate policy rate that achieves their desired outcomes. But in fact, you could look over the last couple of years and over the many years that rather than saying the Fed had a bad forecast, you could say they had a bad estimate of the appropriate funds rate necessary to achieve their outcomes. So, Volker, in your chart, in your table for 2024 and 2025, using the SEPs and the Fed's estimate of the funds rate, it's basically reverse engineering, and it's almost like it's the Fed's hope that their appropriate funds rate achieves their desired outcome. So then what should that funds rate be? Volker, finish it off.
Should we collect the questions, or there's still two questions?
Well, we have two more, Michael and Robert. I can't see Robert's last name. I see his face.
I'll go real fast. So a couple of things. First of all, there are other times, you might note there are other times Oken's law broke down. I had a debate with Art Oken in the early 80s, and Tom Sargent and I kind of pummeled him that it was an exaggeration, so what actually happened. But there are other times as well. One thing that's kind of missed in all this is because the Fed is engaging in such fiscal actions, maybe we want to combine the balance sheets of the central bank and the fiscal authorities, but it was enabling accumulation of a lot of cheap debt for a while, and that was huge capital losses mark to market. And there's big incentives to hold to maturity when that might not be a good idea because they'll be more obvious they're losing a lot of money mark to market. And at some point, that's going to become a political issue, and that's unlovely. And the longer run is something else about it, that fiscal actions in the future are going to have to reflect the fact that interest has to be paid on this debt. And so in some sense, we're trying to do what's the right thing to do. We need to take account of those things as well, both the moral hazard that gets created and also the present discounted value of the cost of having to raise taxes in the future. So $1 of spending in 2021, Harold Ulick has this calculation, agree or not, how he merges the new Keynesian model with the long-run growth model, costs about $3 in present value. So somehow we have to have a proviso on the tail of that. I don't know if there's anything in your model that speaks to that. If there is, I'd love to hear it. Lastly, I was asked all the time, was going to be a U or V-shaped recession. And I, with some amount of bravado, thinking I convinced people to remember high school arithmetic, I said it'd be a tilted square root sign. If you look at your pictures, that's it was obviously a lucky guess, but in any event, that's what turned out to be the case. But I don't think any of the dozens of reporters and others I talked to about it could even remember what a tilted square root sign was. So I never saw it reprinted. So just FYI, but especially in the longer run.
So Robert, is that Bob Hall?
Yes. This is a real quick remark. The enabling legislation for the Fed's activities requires the achievement of maximal level of output or employment. Do we just completely ignore that? Obviously, we're struggling with the problem of two objectives in one instrument, but we just don't even mention it, right?
So, thank you, Bob. Athanasios, do you have a last comment?
Thanks, John. So first, I wanted to give some credit to Volker, not just for this paper, but for actually being behind much of this work. I mean, Volker, I think it would be useful to remind everybody that you were there in the 90s when you were pushing the rules memo to the board. I mean, if I remember correctly, you developed the very first version of the rules memo. So many of these rules were actually already there. Now, in terms of this, what I think is important is the contribution of assessing the importance of supply. This is the key thing that wasn't mentioned in any of the Fed's publications and should be mentioned much more for applying these rules. And right now it applies, as you pointed out, on the issue of what is the R star that you put in these things. And a lot of people are talking about, well, R star is not really as low as it was a few years ago, but we don't really see that in what the Fed is publishing still. I want to make one comment on to Evan mentioned the forward guidance and the commitment. I agree that September 2020 was a mistake, but it did have an opt-out clause, and the Open Market Committee could have easily raised rates in 2021 by invoking the opt-out clause of the September 2020 decision. Had they been paying attention to the simple policy rules that many of us were saying they should have been paying attention, including this paper, they would have avoided this mistake. And this is what I think is the big message that we should keep pushing. The committee should actually institutionalize looking at policy rules in this way to avoid silly mistakes like this.
Volker, you have the last few words.
Yeah, but I can keep it short. I think these were a whole range of very good comments. Maybe just on Bob Hall, maximum employment, absolutely. I think the Fed adding this balanced approach shortfall rules, this shortfalls concept was the idea to take into account the one-sided thing on employment or unemployment. Whether it's a good idea, I think we need to put it in a model. I suspect it might actually introduce an inflation bias if one does that. But anyway, many other good comments. Also, Athanasius, thank you, and the SEP and consistency Mickey Levy talked about. There isn't much I can add right now, but I was just showing the chart. I was not making any statement, but this raises a set of tricky issues. So thank you for all this feedback. And as I said, I didn't, it's the rules in the Fed's report. I'm just trying to use those. And maybe the only strong point here is to say, as Athanasius just pointed out, look, you need to take supply more seriously, in particular when we have so much evidence, like during a pandemic, when you can see the pandemic and the shutdowns. And also in other times, maybe need to bring in more theory to discuss or analysis to discuss the gap in the supply side. So Athanasius reinforced that point. Thank you.
Okay.